Lisa, thanks for joining me today.
Thanks for having me.
You have one of the most interesting backgrounds in commercial real estate that I've ever come across. I like to have all my guests start by introducing themselves and maybe talk us through your journey in commercial real estate.
Yeah. I started, I guess I would say I started my career maybe in high school, which was sort of, walking along the city streets and realizing sort of the impact that the size of the sidewalk and everything really had on kind of how I felt. And, as a result of that, I actually went into urban design, urban planning in undergrad and started to work in private planning practice, like doing, horizontal design for Irvine Company back in the day, laying out golf courses, et cetera. And then I noticed these people called developers actually controlled the design decisions. And I didn't quite understand why they were making the decisions that they were, because it kind of didn't make sense to me. So that's when I went actually back to grad school and got a master's in real estate finance and a master's in really urban economics, and started working in investment advising. Went straight to I went to MIT, and then I went to San Francisco and worked for a boutique investment advising firm where we basically did everything as sort of a project manager. We bought things, we managed those things, or asset managed the things that we bought, and then we also were responsible for the exit. And it was actually a phenomenal opportunity to sort of see the whole journey of the real estate investment process. But ultimately, I wanted to get into development. And Hines hired me, moved me up to Seattle. And that's really where I kind of built my career. And I would say, I had this unbelievable opportunity to, in the .com era, to build over 1 million square feet of spec office space. And have, tech companies lease it, and then I had to unlease it and then release it again.
Right. Sounds familiar.
And then I think, through the .com bomb, realized in some of these West Coast markets that the office market wasn't going to be back for 10 years because we had way too much supply. And I started building multifamily apartments. And I also had a stint of working for Canyon Ranch and being their head of real estate. It's probably one of the most well-known hospitality brands with just 200 keys. And I would say that experience working there was probably the most kind of critical insight, sort of change moment in my real estate profession, because I really got exposure to the hospitality world. I got exposure to what experience does to kind of create value for the consumer. Because, this was at a time before even hospitality was entering into the multifamily world. This was a brand that, quite honestly, when people went to Canyon Ranch, surveyed, when they left, 90% of these people left saying their life was forever changed. So there's something pretty special that this brand was doing to people. And actually, we were, working to kind of create an opportunity where people could sort of live that lifestyle. Zoom forward, I left that experience wanting to be back in Seattle, and Skanska hired me to essentially lead the West Coast development. And we developed some unique assets. And the reason why I took that job is because Skanska was really building everything off their balance sheet. There's no lenders, there's no investors. And if you're a developer, you understand that wherever money comes from is largely who controls the decisions and what gets built. And lenders sort of control the decision based upon managing risk. And really the way they manage risk is building everything that they've always seen and built before. So you really have very little innovation that happens in the real estate space because in essence, we say it's capitally intensive. And so this was a remarkable opportunity in where I like to say I built crazy shit. I hope I can say that on your podcast. And really what I was doing, I was building things that the market craved, and was sort of a little bit risky from the standpoint that people hadn't seen it before. And John Gray happened to walk into one of those assets and said, "Oh my God, we need people who know how to do this." And I got a call and, was brought on board to Blackstone. It was sort of a chance of a lifetime to go, take their existing portfolio of things that they had bought that were actually horribly, performing from sort of a tenant desire perspective, and really help them, sort of shed this office space that they had acquired. And that was a great run for 5 years of where I helped them dispose of basically $11 billion in real estate, of office real estate, and really retool a whole team. And what I realized is that, the efficiency of real estate, we hadn't really adopted much. We're the industry that has least adopted technology. And so, I started looking at technology and ways in which we could sort of, change the cost structure and also, improve upon the user experience. And so when I left, I really wanted to spend some time in venture, and I spent some time with Sway Ventures, now an advisor to Sway. But basically helping founders and working with startups to really approach this industry to help accelerate the change. And now I'm really excited about, the sort of the confluence of both physical assets and digital assets, because I think that's actually going to be where real value comes from in the future. So I'm spending my time, pondering sort of the world, the changes in real estate, the future of cities. I'm speaking, and I'm really, doing some consulting work in that realm, but looking for kind of my next move in that. And it's got to be right of where I want to spend my knowledge.
Well, certainly didn't disappoint on the opening statement of varied and impressive. So there's a lot to unpack, which we'll go through over the next little while here through our conversation. Let's go back to, let's maybe start with your time at Skanska in Seattle. I think one of the things, or on the West Coast, one of the things that you said is you built crazy shit. What are one or two of the projects that you're kind of most proud of that, weren't supposed to happen, but ostensibly did and turned out really well?
Yeah. I mean, I think the thing that was sort of happening in commercial real estate at the time is that, a lot of people were really driving real estate decisions by pro formas and not really about the experience they were providing on the ground plane. And it was really sort of destroying the city, if you will, because we sort of had these ground floors that were occupied by the tenants that could actually pay the rent, the Subways, the Jimmy Johns, all of those kinds of things. And it's sort of like the retail experiences that are actually least desirable by the people who live above them. And when I say live, I mean also sort of work above them. And there's these really unbelievable, neighborhoods in cities like San Francisco and even in Boston and Seattle for that matter. And, if we could live and work in those neighborhoods, we would love it. And so how could we actually bring neighborhood to the city? So we really started to kind of curate the experience. And in essence, we sort of created a Chelsea Market above an office building, probably at the time that Chelsea Market was really starting to kind of surge. And the volume that we created on the ground plane, we actually had a beer pub that was at the entry to the office lobby. I mean, it was just unheard of because office lobbies were supposed to be these mausoleums and these statements to the corporation. And really, people wanted these statements of like the communities they were a part of. And so we really shifted that statement of like, oh, we're not going to build these like massive concrete, or sort of marbled mausoleums, which were a statement to the corporations that built them and a statement to the companies. Because, back in the day when those were built in the 80s, they were really kind of like these symbols that the corporation was going to be around for a long time. I mean, why did Sears build the Sears Tower? I mean, even though, they were the statement of the longevity and the strength of this company. And people didn't give a shit about that stuff, right? They really gave a concern about sort of, what are the cool things they got to do? What was the coffee shop they got to be a part of? What was the bar they got to hang out with, or the lobbies they got to, socialize in? And so we really sort of flipped that on its head, and I would say we maybe had like a 2 or 3% premium for building these kinds of things because we ultimately got 30% increases in rents, for people who wanted to be a part of it. And my ultimate goal was, to have sort of the tenant lobby board and people walk by and say, I just want to get to see who gets to work here, And in fact, that actually happened. So that was one of us, a project called 400 Fairview in Seattle. We were building a large office tower in downtown Seattle. And the whole notion was that, like, God, these office buildings really just sort of destroy the urban environment. So what can we do to get it out of the way? So we had this kind of unique zoning on the site, which really didn't have a height limit. It had an FAR limit, which means the amount of massing you can actually put on the site, the amount of built product. So what we did is we lifted the whole office building kind of 80 feet off the ground, and we built a village underneath this. And so what holds a village together? It's like all these different buildings, but their roof textures were all the same. And so we sort of played around with that idea as well. We built Brooks Sports headquarters into kind of a living building. We built them a trailhead the city's most loved urban trail. So those are the kinds of things we sort of like looked at the customer and we designed it for the customer, where I think when you look at the commercial office market, because these things have traditionally been 10, 15-year long leases, the customer has been the capital markets who buy these bonds of the long-term leases. And the problem is that when these leases get shorter, I mean, like think about what happened with like apartment buildings when the average lease term became 12 months, you really had to introduce hospitality, right? Because hospitality has a turn every night. And so you really have to depend on your brand and the experience so that you can get more consumers to kind of come in. And office is actually turning more towards the customer and the consumer and has to introduce more hospitality. And I think that's why you've seen, brands like WeWork that, obviously were jet fueled, come into the space and offer a little aspect of hospitality. And I think more of that is to come if office, call it the workplace and commercial office, is going to be successful.
I could riff on this with you forever. I want to talk a little bit more about, kind of through your career, and then we'll go back to talk about some of the market fundamentals and the changes that we think are underway over the next, decades. Do you know which building it was that John Gray walked into? Because I think a lot of people would think that that's their dream that triggered it, or is that more of like a metaphorical statement?
No, it's 400 Fairview. Yeah, it's a real occurrence, and because it is pretty drastically different. And I remember the moment, actually, when we were building it and the volume was so big, and I walked through it, and I was like, "Oh my God, I'm gonna get in trouble for this." And I was like, "No. The market is gonna like understand this and feel this space." And so it was 400 Fairview, and the building was almost designed, with a great architectural team, but all of us understood the vision of what we were creating, including all the craft trade that were actually working on the project. So it was a pretty magical project. And today it's a great space in the city, and people know it by the retailers. They don't know it by the name of the building. They know it by the retailers who are there. And that's totally fine.
Interesting. That's awesome. So you leave, you take this great opportunity of a lifetime at Blackstone, massive office portfolio, clearly not built to the design standard of 400 Fairview. You mentioned, one of your big areas of responsibility was to dispose of or kind of fix the portfolio. So how would you, it's, there's probably a lot to unpack, but how would you kind of like summarize what your role was leading, the office portfolio for Blackstone, and kind of like, how do you break that down or compartmentalize some of the different responsibilities or kind of things that you were able to achieve there?
Yeah. I'd have to say that like, I hadn't worked in private equity before. And so understanding sort of the pressures was probably the first year, in private equity. And realizing that the capital that was deployed to buy these assets, was really deployed on the theory that essentially you're going to double your money, over a 5-year hold. Right. And so, much of this portfolio had been held for 10 years, and that's okay as long as you sort of like, triple, quadruple the money at the time that you exit. But the goal was really to exit out of the real estate and exit out at a time when, hopefully the market's, on the upswing. And, a lot of this stuff had been bought at a really, really low basis. So it was just really getting this stuff leased up, right? And so getting things leased up really have to do with really its curb appeal and obviously, its ability to attract tenancy. And so how do you, and a lot of this stuff, was suburban office stuff, which is really, tough to work through. And some of it was like Willis Tower, which was, in Chicago's Loop. And so, which was this 1970s building. It was a behemoth that had a huge, office lobby, had all of this sort of podium that didn't make sense. And yet it had, close to over 3 million square feet there that was sitting in one building. It's just sort of daunting, how many people would show up in this building, and you have this captive audience, including the Sky Deck, which is, the highest revenue floor in the whole entire building, which is crazy. It's like 20% of the building's, total overall revenue. All of these people are showing up in the building, and there's an opportunity to monetize that, to have more wallet share than sort of give it away to the rest of the city. So we really, we spent a couple of years repositioning the whole base of that building, and, fighting a little bit with the local architects who really wanted to build this in the Chicago style. And their vision of the Chicago style was, everything that had been built in the past. And so what we really wanted to do was build, something of that, Fulton Market was kind of exploding in Chicago. And it was all of this sort of like really unique, kind of fabric to the building. And so we repositioned it. So a lot of my role was really retooling the team to understand you didn't have to do everything that was built before. In fact, we could rethink who the customer was, understand who the customer was, and design that. And I think in my tenure there, Blackstone started to attract different, different forms of capital. And that included sort of a core fund, which was, quote unquote, an evergreen fund. So it was sort of like, can we buy assets and hold them forever? And, could an office asset be held forever? I sort of like internally debated about that because I've always been a developer where you sort of build something and you kind of like turn it over to sort of the next ownership. And I would argue today, sitting here with the knowledge that I do have that, office assets are probably the fastest to reach obsolescence. They really age very, very quickly. There's a next new thing that kind of gets built. The thing that you really have to focus on, it's very, very sharpshooting, is the location. So Blackstone had sort of the opportunistic fund, which is really what I came in under. They added the core fund, and then this became this B-REIT vehicle, right? Which was really going to be sort of this evergreen fund that obviously they could trade in and out. It would be sort of a hopefully a liquid investment for investors. And that capital was coming in so fast. And really there was a need to deploy that capital pretty quickly and in sort of like, I would say, stabilized office assets. They were very difficult to find. It didn't make a lot of sense. Quite honestly, because so many of them were overpriced, based upon where, we had zero interest rates. And so some of these things, you were taking an inordinate amount of risk for those investments. So I saw sort of this role of like exiting out of this real estate and really continuing to exit out of this real estate, really kind of morph and shift to sort of thinking about where is capital allocation. And I think at that stage, I was least prepared to sort of really deal with capital allocation because I'm a real estate investor. I'm a real estate fixer. I'm a real estate builder, those kinds of things. So that's kind of how I would tell you sort of the role when I entered into it, and the role like morphing and changing a company, changing culture, within, sort of 3 years of an organization that we were downscaling, right? Because when you're selling off assets, you're also selling off team and team members, you're restructuring the organization. We never were not structuring the organization. There was a constant restructure that was happening, and that was really professionally challenging and also very rewarding to do.
So one of the things you mentioned early on is, maybe the first year was kind of understanding and appreciating the differences between development and private equity. You just mentioned at the end, one of those was this constant iteration of, structuring and restructuring. What else struck you initially as different about private equity as it compared to, development? I'm sure some of them are obvious, but I know a lot of listeners are, hey, I'm a developer and I want to get into private equity, or hey, I'm private equity and I'd prefer to be a developer. You've done both.
Yeah. I mean, I think there is this, absolute militant discipline to sort of your spreadsheet, and I think there's a lot of dependency on, your sort of past metrics and the metrics. And I think as a developer, we work sort of creatively and we sort of have this vision about there is new value to be created. It's very hard for private equity to understand that unless it's sort of seen it and can understand it in another market or in another sort of like, proximate area. And I think like, private equity, we had a hard time sort of thinking about how development would work. There's also this very deep relationship, the same thing in development, but how development would work with, within the model, because essentially you've got to basically, 2x the return and not take any risk somehow. And so a lot of that is like buying, below replacement cost. And when you're developing, you're not ever buying below replacement cost. So, a lot of those deals for Blackstone were really done in a JV relationship, just because I think there was this inherent fear around development. But I would say sort of, that there is this absolute discipline to the spreadsheet. Probably is the thing that I kind of pull away and I sort of take with. And there's always sort of this need, like, let's look at the math on that, right? As opposed to, I would say, creatively thinking the exercise and really making a market. To me, there wasn't a making of the market, right? There was sort of like, finding the opportunities to sort of arbitrage a moment when values, or we could buy by the bottle and sell by the shot. I think that is sort of the classic private equity model.
Yeah. So you had, so last question on Blackstone, what your tenure there, what were the years, just so we can orient, because Mark has been through a lot of tumult.
Yeah. Yeah. So I came in late 2016 and really became the CEO in 2017. And then, in essence, left at the beginning of 22.
22. Okay. So you were there through kind of the pandemic. All right.
Yeah.
So
managing a team through the pandemic, when really every day you're looking at the press that's telling you that your sector is dead, right? So
yeah. I mean, I wasn't going to go there, but since you took me there, like leadership lessons, what did you take away from that experience? Obviously very challenging.
Yeah. I mean, what was pretty fascinating for me is that, when everybody was in person and the moment you sort of retreated into your own homes, people left to their own devices will create their own stories, right? And so we went to actually having an all hands. We had an all hands once a quarter, with a staff of 200 people, right? Spread across the United States. And then we went to basically being on a call, just status and updating and talking through stuff every week, right? Then we kind of dropped back to every other week, but it was almost sort of like these rah-rahs hold it together. And it was kind of fascinating because, people who, their spouses, who their company or their leadership wasn't having any communication, they were sticking to sort of a quarterly or even a monthly schedule. They had their spouses listen into our calls because it was somehow sort of like this satisfying way of feeling resilient, and connected to something. Because like the minute you're sort of pulled in retreat and you're left to your own devices, your mind starts to think and wonder and position itself as thinking that the world is falling apart. And so, even after I left, like people were saying, "Oh my gosh, I'm really disappointed you're leaving," but who's more disappointed is my spouse.
I love that.
So I think what the big lessons was like over communicating, and that the over communicating was one, you create a resilient labor force, but the other thing is that like the messaging of the direction of where we were going as a company got reinforced so fast. It was astounding to me, and even though I felt like I was repeating myself, every other week. It took like 2 or 3 weeks for things to set in, as opposed to 2 or 3 quarters, right? So the over communication really accelerated the growth of people, the resiliency of our people, and also the resiliency of the organization. That was probably one of the biggest learnings, during that time, in leadership. And I just think that continuing to plan and to sort of think through and ideate and create ways of which you can connect with your customer. We continue to do a lot of work, as opposed to sort of like be in the defense. Because I think what happens is when you're in remote, you tend to just rely on all the things you knew how to do and all the things you have been doing, as opposed to like really engaging in kind of new work. And the offense piece is really hard for organizations when they're kind of pulled in remote, even now when you're sort of doing a lot of hybrid work. And so how do you actually get leadership involved? Because I think there is a dearth of leadership. There's a lot of managing. There's a lack of leadership. And so we really instilled within our teams and within our leaders to really be leaders during this time.
I love that. Well, we'll save that for a whole episode that I'm sure we could do on leadership. So you had mentioned at the outset, you spent through your time at Blackstone, one of the realizations and earlier in your career was the role that technology could play on the evolving office space. And that led you to Sway. Let's spend a little bit of time. Like, what was that connection more specifically that you saw when you said, there's something more to do here? Technology is an enabler. Like, what was it about technology that you were hoping to unlock for real estate and for offices?
Yeah, I've actually written a few pieces on this on my Medium channel. But I've also, I believe that, if you look at how much, how little investment has actually happened to the real estate sector, that's one that, like, all the things that we sort of expect and have in our everyday normal life, whether it be now with our cars or in our homes, doesn't exist in the real estate world. I mean, it's why do we still have to hunt around, for 15 minutes for a parking space in our cities or in a shopping center or even at the airport, right? Like some of these things could just be better planned or processed. That's just a really crude example that everybody probably experiences at some point in time if you drive a car. um, but also we've had 20 years of deflationary pressures, and I say deflationary pressures, on businesses, whether it be the offshoring and our supply chains getting cheaper, that wasn't going to last forever. In fact, it didn't, right? And so I knew that there was going to be inflationary pressures across the entire, P&L, right? And I knew that labor was getting more expensive. I mean, every year was getting more expensive. It was also getting harder to find because the lack of talent and the lack of people who are maybe entering, certain aspects of the profession were going to get tougher. That we needed to figure out how to get, machines, algorithms, things to do the things that actually humans don't want to do. And quite frankly, aren't that good at doing, right? So we started to kind of play around with various areas of technology to start to just augment our labor force. I mean, if you think about it, most property managers have 150 things they need to do on a property in a day, and they have time for 10, right? And it's largely just because we haven't actually deployed the technology, but also I think, because they have 150 things to do, they don't actually want to learn a new thing because that's just one more thing they have to do. So introducing technology into the property stack is very, very difficult for that reason. And so, because, excuse me, normally what you have to do is you have to sort of run analog and digital side by side because, people only trust the analog. And so when you introduce sort of a digital solution that, it's going to save them half the time, they don't trust it. They actually have to do both of them at the same time, which is double the work. And you just have to get through that phase and leadership has to support it. But my point is it has to be done and it's not getting done. And so I was deeply interested in motivating, creating space for the workforce to actually introduce technology, and people got excited about it. And we actually started to see improvements in, I'm a deep believer of removing labor from the back and pushing people to the front so that the human experience is actually better. And not driving technology or UX to the forefront and then pushing more of your labor force to the back. I think it's the inverse. And a lot of the technology that came forward into the real estate sector was really driving more UX and upfront sort of customer sort of interfacing stuff, which I think is good if it actually takes pain points out and solves problems. But a lot of it wasn't solving problems. It was creating more problems. So anyway, I got deeply interested in how we can actually work some more deflationary pressure on, our expenses, and really started to deploy it. And I also saw some resistance, within Blackstone for, expenditure and spending time on that. And I understand it because it's sort of it's not the way we've always done it. And there is some experimentation that needs to happen, and it can cost some money. But ultimately, the deployment of the right technology is shown to be incredibly deflationary, and also, in enhancing the productivity of your labor force. And we noticed that. So I wanted to spend more time on that specifically and helping founders, because we'd see founders that were trying to introduce themselves into this marketplace. And those founders really didn't understand sort of fee structures, costs, all of those kinds of dynamics that can really inhibit whether or not a company will adopt the technology, because there are really sort of wonky fee and cost structures, how you develop, how you assess fees, how you pay for things, who pays for what, whether it's the tenant or whether it's, the property. So those kinds of things I really wanted to help founders so that we can accelerate technological improvement within the industry as a whole.
Are there any specific areas, that you either were or are focused on? Is it fair to say kind of the built environment, the physical plant of the asset, or are you looking as broad as kind of the urban fabric of cities and everything in between?
Yeah, great question. I've been deeply interested in, areas that actually provide immediate ROI for owners, because essentially when you start having interest rates rise, you suddenly have an enormous new cost structure that is just, it starts to chokehold most assets. And so what do you need to do is you need to figure out how to take costs out of the equation. So, I was looking at sort of technologies that, removed expenditures, whether it be on elevator maintenance, whether it be on, how often you had to spend CapEx on equipment. So if you were monitoring and managing equipment and you were sort of tracking vendors, et cetera, you knew that like, oh, that this, the MEP equipment only had, half the load it normally has on it. So actually we can extend a CapEx expenditure. We don't need to spend it this year. We'll spend it next year. Those kinds of things I thought were, appropriate uses of immediate technology that can get deployed, now. I'm deeply interested in a lot of the technology that's starting to kind of organize, the in-house data so that essentially the generative AI models, when they're here, they're not necessarily here yet, can actually be layered on top so that, the data doesn't necessarily be structured, but people who are inquisitive and not have a curiosity level can begin to ask really smart questions and begin to create new investment strategies based upon the data that's held internally, because that will be powerful as we're finding out with other organizations that have organized, not maybe necessarily organized, but have collected the data of their customers, consumers, and just the business. Those are some areas I'm deeply, deeply interested in. The whole sort of like, cap table, financing structures, managing, your debt, like a lot of those are super interesting to me. And I think there's still a lot of room to run in terms of how they integrate with, the operations of the building, how they integrate with, understanding the customer and organizing sort of your capital structure for the assets and organization. And then all the way to like, getting a better understanding of your customer and designing the product and gearing the services more appropriately to the consumer, like that has happened in every industry on the planet, with the exception of real estate. I mean, we're starting to see a lot more of that in hospitality, quite frankly. But the hospitality model still is, if you look at the big giants, they haven't really morphed their model to really accommodate what the consumer wants. We're seeing, modifications of new typologies of hospitality enter the space that is more tech driven and probably less service up front. And then you don't need to necessarily have all the service level that kind of comes with these really expensive hotel models. I do think, Brandon, what's going to be really interesting is that technology has always created asset classes. I mean, you can sort of look back to sort of the creation of the elevator, obviously allowed uses to get vertical to, most recently, the discovery of life science bioscience has created a whole life science sector, right? And then if you look at data centers, you look at cell towers, I think we're going to see some new asset classes come forward in the real estate category that is driven specifically by technology. And, you can't really get into the data center space or the cell tower space unless you understand the technology. So, understanding some of these forthcoming technologies and, what it's going to create in our cities is really important to me.
So if you're a founder listening to this podcast right now, you've been in the venture partner seat, you've, educated, advised, invested with founders. What should founders know about kind of the real estate venture, real estate technology space that, you would only appreciate if you've kind of been deeply inside of it like you have?
Yeah. I mean, it's interesting. I've been a part of a shop that is sort of like a specialist generalist. And there are generalist VCs out there that sort of, believe they can kind of invest in everything. And I do think there's a little bit of, or a lot of bit of gambling as it relates to that. And then there's very sort of prop tech specific, venture organizations. Look, after being in it, I think, the whole prop tech space, it's very hard to find, a way in which you're going to create a valuation that's going to do 100x, value in, the time frame that venture really, expects these wins to happen. So I think, the sort of the prop tech investor who has a deep knowledge of real estate and can give guidance to those founders about how to structure, how to think about, the way their product market fit, how their pricing model works. At least, they can look at sort of a trajectory of where they're going to have a medium-term success, because I don't think like quick short-term success in the real estate sector is really possible, quite honestly, just because of how long it takes for adoption. One technology, even, if I'm implementing Junior per square over here and I'm going to go, implement, a PM service module, or I'm going to implement some construction tech within the company, both of those are taking resources of the company and they're actually competing with each other. So you're dealing with like a lot of areas in the whole real estate organization that really need technology. And so the focus really has to be solving on a current problem that every real estate owner is facing. Because if you're just I would tell you a lot of the tenant experience apps were sort of like, these sort of shiny, glossy objects, which weren't really solving a problem. They were sort of like, hey, you've got to monetize your customers. You got to get more wallet share. Today, you actually have to solve a problem. You have to deliver immediate ROI. That is sort of the first advice I would give to any founder who's in the prop tech space or is looking to kind of approach the real estate sector. And then, I just believe that the whole industry as a whole it just takes longer to generate, the kind of like significant player, returns that is going to be, dominant. I mean, even if you look at sort of how long it took Airbnb to kind of come forward, it was sort of a disruptive player and it's almost kind of its solitary space. It kind of created a whole new category within hospitality. Most of these sort of players are creating some sort of middleware that's just going to take some time to evolve. I don't know if every prop tech VC, believes that. I mean, they certainly haven't sold the fund dynamics, based upon that. But I do believe that the venture capitalists in the prop tech space that do come and have an understanding of real estate will be the most successful in this category. And so, really play towards them.
Yeah. Good advice. So let's move into the kind of the core, office building. You've used a few words. I mean, we've talked about the relatively slow rate of adoption of change for our industry. We've talked about the massive oversupply and potential obsolescence of office space. We've talked about the impacts that COVID has had on the psyche of our workforce. Like all of those things essentially come to a head in the urban fabric or the fabric of our cities and the utilization of office. And what do we do? So it's intentionally a broad question to get us started, but, through your lens, like how are you beginning to approach, the future of office, if you will, and maybe, start up here and we can kind of work together to unpack that.
Yeah. I mean, I've sort of said that, office is facing a triple whammy. And the first, major whammy that the office or commercial office market is facing is the fact that there's a secular shift. I think in prior cycles, we could sort of say, hey, there's a cyclical, sort of shift. We've got sort of like a change in employment because essentially the office market has been strongly tied to kind of hiring and job dynamics. There'd be somewhat, based upon the cost of real estate, you might see some consolidation or some compression in terms of how much space, a user would use. But I think the secular shift is just almost a cultural one that kind of came about. It was really present before the pandemic, but I think it really accelerated during the pandemic, in which there's this, shift of, I would almost call it lifestyle. And you see it predominantly, kind of in the West Coast cities, probably more so with the technology companies that were resistant to kind of really draw people back. But it's obviously the return to office, call has been a lot stronger now. But even then, the occupancy or the utilization of these office buildings is probably, let's call it 30% off of where it was pre-pandemic. And this secular shift is really changing the whole city dynamics. And if you think about the fact that some companies are doing, we're doing, in office presence Tuesday to Thursday. Some companies realize that that's actually like the worst days of traffic and we don't want to be a part of that. So let's sort of like, shift counter to that. Fundamentally what's happening is the retail that we all love in our cities and the reasons why we go against that friction is to be a part of something and, to have all of the amenities and services that are right there present to find, to get food, to, if it's like, to get something cleaned, or if it's like you get to see your doctor or your dentist or whatever it might be, like there's this sort of concentration that like that whole economic model is, relying on 30% of the demand not being present, and even though their rents haven't changed. And so it's a lot of the reason why we also see sort of a lot of our restaurants in cities, shift from Wednesdays to Sundays. It's really hard to find a restaurant that's open, Monday or Tuesday, right? So I think that, cities have to really engage in a different cost model. So there's this first whammy, which is just that the foundations of demand are shifting. The second piece, has a lot to do that, over the last 10 years, we've oversupplied, the office product, and we've overbuilt it. And in fact, we'd usually see like 1 to 1.5% of the inventory getting replaced per year in a city. And some cities like Austin have 8 to 9% of that inventory getting replaced, right? And so, consistently over the past few years, and I would say consistently over the past 10 years, we've seen like 2 to 3 to 4% in some of these like really high growth cities. And so we had this massive oversupply. And the interesting statistics is that if you look at office that is older than 8 years old, which is basically saying that it's maybe getting past its first lease cycle, right? Because brand new buildings have like most owners of a brand new building really dictate that if you want to be in this brand new building, you have to sign a 10 or a 12-year lease. And that's really to kind of pay for the improvements that are put into place. So after that first 10 or 12-year lease burns off, right, that building loses points of occupancy every year of its existence. And so in other words, like really random obsolescence. So we have all of this office product out there now, which is, I think the national vacancy or availability rate is over 30%, right? And if you look at like a lot of these buildings have been financed, majority of them have been financed, right? Whether it be with regional banks or insurance companies, where they require a 60% loan to value. In other words, they borrow 60%, right? Or 65%. And in some cases, that's gotten even higher to like 70%. Many of these aren't going to be able to afford the mortgage when the vacancies come forward. Another interesting stat is that in between now and the year of 2025, 35% of all leases that are out there will expire. And so when they do come up for expiration, some are renewing. I mean, the big law firm in New York just renewed, and they actually didn't downsize, which is pretty remarkable. But when they renew, the common tendency today is actually downsize because they don't need as much space as they had. I mean, we had, the predominant leaser, in the last 5 years has been these technology companies that have gone and leased, massive amounts of space, and they basically lease new buildings. When you lease a new building and you have to sign a 10-year lease and you're assuming, you're going to grow, let's say 5% a year, over, or 10% a year. Actually, they're assuming 10% growth. You have to get double the space you need today than, what you're using today. And so all of these tech companies did this. And keep in mind, in like 2021 to 2020, so that 1 year, in 2021 to 2022, the majority of these tech companies they increased their labor force by 30% in 1 year, 30%. And so then they also went and secured office space if you were like Meta, or if you were Microsoft or Salesforce, et cetera. And now, if you look at the stats, they've only actually shed about a third of what they've hired in 2021. So even though there's like mass layoffs, right? So I think, the amount of demand is going to be reduced from the fact that like we've changed the working model, and yet we haven't defined it yet. I mean, I think this is a huge opportunity for both technology and also physical assets, is to redefine what work looks like, right? And I'm spending time with some owners on what does that look like and how do we reshape it so it actually, gets people inspired to drive against the friction to kind of come to this new thing. What is this new thing, right? And I think that's super exciting to me. But to do that, I actually think that the valuations of where office has been, they've already gotten reset from the public market perspective, probably 30, 35%, they're off. And the private markets haven't reset yet. They're a little bit like, I think, alcoholics who have like cirrhosis of the liver, and they're not maybe they've stopped drinking, but they still haven't actually gotten help to sort of like, ameliorate the situation. So we have a lot of sort of like sick people out there that aren't getting help, and they'll stall it for a long time because the perception is that that's weakness, and it's hard to raise money or get people to kind of party with you if you're not drinking, right? To keep carrying the analogy. So I think we're going to have a mother of all resets in cities. And that mother of all resets is actually welcomed because that is the moment of innovation. We can't innovate at the price levels right now. But the minute these things get underwritten, to 20 cents on the dollar, 30 cents on the dollar, there's a lot of interesting innovation that can happen. People sort of move in with ideas and test what a workplace might look like. But when I have to spend, $80 a foot a year on a rent versus $10 a foot or $15 or $20 a foot, I'm likely not to take the space, or I'm likely to find solutions that, get me by until there's sort of a reset. So that's the second whammy. The third whammy really has to do with long-term interest rates. And I think there's been sort of this conventional thinking that long-term interest rates are actually going to come back down. And I think if we think that this inflationary number is going to be nagging for a lot longer, and I think we saw over these last couple of weeks that the central banks are sort of agreeing that, I think this is going to actually be longer. And we saw the 30-year and the 10-year really blip up to a sort of a 15-year high. That if, long-term interest rates are actually going to remain at a higher level than where they are before, what risk premium do I need to essentially hold a real estate asset? And if it's 200 basis points higher, in other words, I need to have a higher return, well, that means the values of these assets have been bloated for quite some time. And I will tell you, over the last 15 years, you could buy anything and make money, and those days are changed. You actually have to be a sharpshooter. You have to be a skilled real estate, individual. And it's largely the reason why I'm super excited to get back into it.
So if you think about this capitulation that needs to happen in order to have the mother of all resets, to use your terminology, in the meantime, there's a lot of sick people, keeping with your approach, and there's doom cycle headlines, whether it's San Francisco or Portland, or pick your favorite city that is in the headline for the day. Like, what is this? Like, what is your thesis on the fundamental health of kind of gateway cities in this country? You get a lot of the public market and even the privates, the Odyssey funds, who are core funds who by definition have to invest in these markets and gateway cities. So on one hand, you hear they're healthy and there's nothing to see here. Don't look at that headline, look at this one, and everything will be okay. But on the other hand, there's people who are living on the ground, working in the buildings, or trying to, and are experiencing some of this hardship. It's a social problem. It's an economic problem. It's a civic problem. So kind of how do you reconcile the timing gaps that might be required to see all this play out?
Yeah, I mean, I think the fact that a lot of private capital and private debt has kind of gone into this market, it's going to take a long time to sort of shake out. And I think the longer things go on, there's going to be a lot of opacity about, what's buried where, until like something big falls. And then I think the opacity sort of gets shook out. And so what's the kind of the famous quote is like, how did you go bankrupt? It was very, very slow. And then all of a sudden, I think that's what's going to happen in the office market, but, or, in cities, for example. But, to your point about, San Francisco, Portland, I mean, cities have if you look at the history of San Francisco, they've had these boom bust cycles and these sort of like, moments of where it's like, oh my God, they're never going to come back. Right. But we can't forget the fact that these are the centroids of where everybody's located. Right. And we're humans. And as humans, we want to be together. And so what's the natural point of where you want to be together is the centroid of where everybody is located. And so these centroids, yes, have a lot of political issues, have a lot of structural issues. But I do know that, like, you can take, let's take even an example when refrigeration came in. It's a small example, but when refrigeration came in, the meat markets and the produce markets of every city died and went fallow. And these became sort of these like vacant warehouses. And until they got marked down, they became opportunities for artists and new food venues. And then next thing you know, everybody wants to be near that. And that's just one sort of small cycle of like, technology can destroy, but then also sort of create. But it is like these moments for like when you talk about, the institutional investors and the pension funds have to invest in these gateway cities because they are, I mean, office assets have been these like big chunky big chunky assets. You can deploy a lot of capital. They've been obviously super awesome for the Blackstones, the Brookfields, the KKRs, because you can get a lot of capital out when the money comes in, right? And that has now become sort of a moment of uncertainty. But I do think that, this is not about going in and buying anymore, 50 bushels of, San Francisco office, right? You can't go, I mean, you could go in and buy 50 bushels of like Austin apartments. You can buy 50 bushels of Phoenix apartments based upon sort of the broader, spreadsheet dynamics standing afar in New York, right? And I think what's going to happen, office isn't going away. We all need places to come together and ideate. But is it going to be a complete sharpshooting business? You can't buy it from a spreadsheet. You actually have to know the local dynamics. And so, the institutional investors have to be partnered with really smart local people who understand those dynamics and the energy of the grid and where it's going and how to keep feeding that energy, because it is going to be super dynamic and there's going to be a lot of value to be had and there's going to be a lot of value lost.
Do you think there's a scenario where let me ask the question differently. Obsolescence, no matter at any price. I mean, what happens to some of these assets that, is it just a situation of we start to tear them down and rebuild back better, something different that meets the needs of the time? Or, do we kind of have zombie buildings that don't meet the sustainability codes, that don't meet structural codes, that are uninvestable and uninhabitable? I mean, how do we think about that?
Yeah, I mean, the folks at buildingtransparency.org who do all sort of the carbon calculation for new buildings will tell you there's nothing more destructive than a new building, and I think like people who, we like the nice new shiny object, but the fact of the matter is the reinvestment in existing infrastructure, and existing buildings, even if you reskin a building with like new glass, new chromatic glass or whatever it might be to make it look really good. I mean, granted, some of these like interior spaces, kind of a little bit of a column forest. But in some cases, that's been very sexy to some companies in these like older, brick and timber buildings. But my point is that like, I think the notion of conversion to residential is a little overplayed because not all of these buildings can really accommodate, that kind of intensity of plumbing, and also the depths of these floor plates in office buildings don't actually work. So I think, Brandon, if you start seeing that, like the way that this sort of model, the office model worked is that we funded all of your improvements. We assumed that we ripped all those improvements out and then we put in new improvements every time a new tenant came in. I mean, can you imagine like an apartment building where like I went to go lease an apartment, said, I like this, but I don't like where the kitchen is, like move it over here. Right. And then that owner would go, well, how am I going to get recovery of that cost of ripping that all out? You need to sign a 10-year lease. And I'm like, I'm not signing a 10-year lease. I'm only doing a 1-year lease. We haven't really I think educated the market on the sustainability of, or the non-sustainability of new buildings because they're enormously destructive to the environment. All the new concrete that's actually created for it versus the embodied carbon that's, sitting in an existing office building. And many of those like floor plates and portions of our city are like fantastic. Right. But I think a lot gets solved in the creativity of what to use these spaces or how to think about these buildings when they get marked down in value.
So we're almost out of time. We could go hours and hours and hours. I love this. It's fascinating. It takes me back to my early days when you and I met when I was with the Urban Land Institute. So it really strikes a chord. But for people listening and, kind of with your, for whom the message that you have is kind of resonating. I mean, what advice would you give to operators today if they also see this kind of, structural shift happening? And what's the best way to be a part of it? Whether you're an owner, a capital provider, a technologist, like how do you kind of summarize all this into something that's actionable?
Yeah. I mean, it's a great point. And the first thing that I typically do is just sort of take inventory of what you have, right? And then you also have to sort of like, take inventory of what the market really wants. And the market being sort of the consumer, the people that are actually leasing space, And then you have to get creative in terms of deal structure. And I do think that like a lot can be solved with FF&E, furniture, fixtures, and equipment, than like less building walls. And there's some new technology platforms that actually allow for the recycle of furniture and then the reinstallation of new furniture that fits a different function, because that furniture really starts to kind of create a different vibe. But I think the biggest step is really taking inventory of what you own. And what's shocking to me too is like there's very few applications, in the real estate management space that actually allow people to understand their inventory management. There's a lot of things that manage leasing. There's a lot of things that like manage, cost structures, but nothing that really manages inventory. Like, as if it were sort of a SKU on the shelf and it's been sitting here for this long, and how long did, what can we do to sort of like turn that SKU?
Just real quick, what are you referring to as inventory? Like actual like FF&E, or inventory like what is in my space? Total space. Gotcha.
Space.
Wow.
Yeah. I mean, space is just like having, kind of a SKU or a bottle sitting on the shelf that hasn't moved, right? And a lot of owners have no idea how long that space is sat vacant, or, what are the dynamics, and take an inventory of why that SKU isn't moving. And what do you do to push it, right? What do you do to move it off the shelf? A lot of times people discount, right? And owners aren't even doing that. And discounting could also mean like, what are you doing to add, some space or add something to the space so that essentially a customer will actually lease it and use it and move that inventory off the shelf. I mean, when you start to think about like vacant space within your building as actually, inventory that's sitting there that's costing you money and I haven't moved, then I think you act a little bit differently. And the real estate community is not viewed it that way. So I think that's a big piece, is taking inventory of what you own, what you have, and what the customer wants, and then trying to fill the gap and bridge the gap between those two things. Because the leasing activity has picked up in this last quarter, right? Also, the net absorption has like dropped because we have more inventory kind of coming into the marketplace. But there are tenants out there that are actually leasing space, and if you're not getting any of it, you obviously don't have a product. And if your product is just competing on price, you're a commodity. And so how are you actually changing the product so it's not a commodity in the marketplace? And you actually have to offer product differentiation. And a lot of owners don't know how to do that because really their customer has been the capital markets and the people that buy the buildings at the end of the day.
Well, it's been a fascinating conversation. If our listeners want to find you, learn more about your thinking, be in touch, what's the best way for them to do that?
Probably the best way to reach out is on LinkedIn, Lisa Picard. And another way is just, I think, to follow my Medium channel. I think I will be posting and writing more content there about sort of what I'm seeing and thinking.
Awesome. Well, thanks for joining me today, Lisa. Great conversation.
Thank you. It's been fun.